Hey guys, this September, gold is going absolutely crazy. On September 1st, it broke through $3,550. On the 2nd, $3,600. On the 8th, $3,650. And on the 9th, it smashed past $3,700, setting a new all-time high. No pullbacks, no breathing room like for knockout punches, one after another, leaving everyone who's short sitting on the sidelines, or even lightly invested, totally stunned. How did gold suddenly become this unstoppable? Is it just retail investors pumping it? Or is big money driving the rally? More importantly, with the Fed likely cutting rates in September, U.S. stocks started climbing on the 9th, with all three major indexes hitting record closes. Can this year's rate cut break the September curse for U.S. stocks? If it does, will that affect gold's momentum? Hey everyone, I'm Luna, here to help you turn macro trends into real portfolio gains. Today, we're not only breaking down the core reasons behind gold's surge, but also connecting the dots between rate cuts, U.S. stocks, treasuries, and gold. What's really going on? On one side, gold is soaring. On the other, U.S. stocks are showing undercurrents of volatility. What should ordinary investors do? Beyond all the noise around gold's epic rally, what other safe haven assets are 90% of people overlooking that can help you protect your returns in these turbulent times? Smash that like button, hit the bell, subscribe first, and then watch make it a habit to profit from your investments. First, let's tackle one question. Why has September been so wild? Why did gold break all-time highs and reach $3,700 beyond the U.S. budget deadline, seasonal demand increases, and global geopolitical tensions? The key trigger that made this year's story go crazy starts with a jobs report. So bad, it made people doubt the statistics software. On the evening of September 5th, the U.S. Labor Department announced only 22,000 new jobs were added in August, compared to an expectation of 175,000, a huge miss. Even worse, the previous 2 months' numbers were revised down significantly, cutting 21,000 jobs in total, completely shattering the strong U.S. labor market narrative. The moment the data dropped, it sent September rate cut probability to the moon. That same day, the CME FedWatch tool showed the chance of the Fed holding rates steady was just 0.6%, while a 25 basis point cut was priced at 99.4%, almost 100% bet. There was even a 27% bet on a 50 basis point cut. The market reacted like a cat stepped on its tail, screaming and sprinting into gold because everyone knows when collapsing employment meets sticky inflation. The Fed is stuck. Cut rates, and inflation might flare back up. Don't cut, and a hard landing could hit instantly. So global capital voted in the most primitive way: snatch gold. If they couldn't get physical, they bought ETFs. If not ETFs, they bought miners. Layer by layer, the buying frenzy drove gold up insanely in just 9 days. Depth. This isn't just buying the rumor, it's doubt in the entire fiat money system. Some might ask, why are rate cuts necessarily good for gold? But let me give you the simplest logic: gold doesn't pay interest holding. Gold doesn't earn you interest, like a bank deposit, or dividends, like stocks. So, when market rates are high, the opportunity cost of holding gold is high. For example, when the Fed hiked rates to 5.25%, people preferred parking cash in the bank to earn interest. Gold naturally struggled to rise. But once rates fall, bank deposits yield less, the cost of holding gold drops, and money naturally flows into gold. But this gold rally isn't just about rate cut expectations. There are two deeper reasons most people are missing. First, the central bank gold accumulation wave, something we haven't seen since 1980, according to the World Gold Council over the past 3 years. Global central banks have bought over 1,000 tons of gold net each year. In 2024, they bought 1,045 tons, a 70-year record. The People's Bank of China has been increasing its gold reserves for 30 consecutive months since 2022. By the end of August, its gold reserves reached 74.02 million ounces, up 60,000 ounces from July. Turkey, India, Kazakhstan, they're all buying like crazy. Why? Not because gold makes money, but because they're scared. Think about it. During the Russia-Ukraine conflict in 2022, Russia's $300 billion in foreign reserves were frozen. They couldn't use a cent. That was a wake-up call for every country. Holding dollars or euros is risky if geopolitics flare up. They can be frozen instantly. Only gold, this hard currency, can be exchanged for money anytime. So central banks stacking gold is essentially de-dollarization, ensuring their foreign reserves. The second reason, confidence in the current monetary system is crumbling. You might have noticed. This gold breakout isn't just any all-time high. It's above the inflation-adjusted peak from January 1980. Let's do the math. back in January 1980, when gold hit $850. U.S. inflation was 14.8%, crude oil was around $38, and the federal funds rate peaked at 20%. Adjusting that $850 for inflation to 2025. It's exactly $3,640, and on September 9th, we hit $3,700. That means gold has truly outperformed 45 years of inflation and all illusions of paper wealth. In 1980, the dollar had just gone off the gold standard. Inflation was raging, and Paul Volcker used 20% rates to crush inflation, but recession and high unemployment followed. Nobody trusted paper assets, and gold soared to $850. Now, U.S. debt and deficits are through the roof. Trump's tariff policies flip-flop. Even the Fed's independence is questioned. People are worried. How long can the dollar remain the world currency? Can we still trust U.S. bonds? The market sees through this paper tiger. Cutting rates is politically correct. Hiking rates is economic suicide. So gold becomes the only asymmetric bet that central banks can't print. Thus, gold isn't rising in price, it's rising in trust. When people lose faith in the dollar and U.S. bonds, they turn to gold. It's the market's safe haven instinct. At this point, it seems like neither rate cuts nor hikes can fix the economic situation. So why have U.S. stocks started to rebound these past few days? Can this year's rate cut break the September curse for U.S. stocks? And if it does, will it affect gold's rally? Don't. Let's first break down a key logic. The benefit mechanisms for gold and U.S. stocks are completely different. They might even be opposites. Right now, the U.S. stock market is rallying on expectations that rate cuts will stimulate the economy. For example, people think lower borrowing costs will boost corporate profits. So tech and consumer stocks are rising. But this kind of rally is buying the rumor. Once the Fed actually cuts rates by 25 basis points on September 17th, it could turn into selling the news. What news? The S&P 500 is at historically high valuations, with a forward PE ratio of 2 to 1. Slowing employment may signal weakening economic momentum. Inflation is still above the Fed's 2% target. The heavy concentration in AI-related tech stocks makes the market vulnerable to swings in that one theme. At the same time, traditional September pressures remain. Pension and mutual funds rebalance their portfolios at retail buying activity decreases, and companies pause buybacks ahead of Q3 earnings reports. Even worse, tariff costs haven't been fully absorbed yet. Trump's tariffs on imports are now filtering through to consumer prices, like furniture and electronics, which will squeeze corporate profits and hurt consumer spending. Take Nvidia as an example. On September 5th, when the weak jobs data came out, you'd think strong rate cut expectations would boost tech stocks, right? But Nvidia fell over 4%, hitting a low since July 1st. Why? Because people suddenly realized rate cuts won't solve Nvidia's core issues. Will demand for AI chips slow down? Can data center construction keep up? Instead, if rate cuts reignite inflation, the Fed might be forced to hike rates early, which would crush tech valuations. But gold is different. Even if U.S. stocks peak and correct, gold can hold up on safe haven demand. Take Europe right now, it's looking risky. Polls in the UK, France, and Germany show far-right or populist parties leading simultaneously for the first time. France's national rally, anti-immigration and anti-polls show its candidate could win the next presidential election. The UK's Reform Party, anti-immigration, has surpassed both Conservatives and Labour. Germany's AfD far-right party is polling neck and neck with the ruling party, even slightly ahead. If leaders can't solve immigration and cost of living issues, Europe could face political turmoil. When that happens, money will flee U.S. stocks and euro assets. Where will it go? Only gold. There's another key point. U.S. stocks rely on liquidity, while gold relies on risk. If, after rate cuts, the U.S. economy doesn't improve, but instead stalls with inflation still high, that's stagflation, and then U.S. stocks will fall because corporate profits suffer. But gold will rise because only gold can hedge against both inflation and risk. For example, during the 1970s oil crisis, the S&P 500 fell about 48%, but gold rose from around $35 per ounce to a high of $850 per ounce, a gain of over 23 times. This is why gold is more resilient than U.S. stocks. In other words, U.S. stocks might rise, but gold will definitely rise. Now, some of you must be asking, how long can gold keep rising? Is it too late to buy? And are there other safe haven assets besides gold to diversify risk? Don't worry. I'll explain both, especially the second one. Many only know about gold but miss even crazier opportunities. First, let's talk about gold's outlook. Rob, from an institutional perspective, it's almost universally bullish. Goldman Sachs has repeatedly raised its 2025 year-end gold target, saying if the Fed's independence is pressured politically. Just like Trump interfering with Fed policy, causing capital to flee U.S. bonds, gold could rally further. Morgan Stanley is more aggressive. Setting a year-end target of $3,800 Oz. They say the negative correlation between gold and the dollar is key. The dollar index is falling, and as long as the dollar stays weak, gold will keep rising. China Securities Co. is also strongly bullish, believing gold has the potential to break previous highs and start a new rally, like in the 1970s and post-2008, and this rally isn't over yet. Of course, short-term gold has risen too fast and might pull back. For example, after the September 5th jobs report, some investors took profits. Sell. We might see some short-term selling, but this isn't a bad thing. It could be a chance to buy the dip at safer entry points. If gold trades sideways, consider dollar cost averaging into gold ETF's low barrier, low cost, perfect for ordinary investors. More importantly, gold's long-term logic remains intact, as long as the U.S. has high debt and deficits, as long as the Fed's credibility is questioned, and as long as global geopolitical risks escalate. Gold's safe haven plus inflation hedge attributes will hold. For example, USF EDERAL debt is over $37 trillion, and annual interest expenses exceed the defense budget in this environment. With Trump adding to the uncertainty, the dollar's credibility can't stay strong forever. Plus, central banks are buying gold for the first time since 1996. Gold's share in non-Fed central bank reserves exceeds U.S. Treasuries. Bet. This shows central banks prefer gold over U.S. bonds, a structural support that will keep gold in a long-term uptrend. Next, let's look at other safe haven assets worth watching. This part might be more important than gold. Because often these hidden safe havens rally even more than gold and help diversify single asset risk. The first category, strategic commodities, especially energy, copper, rare earths, and uranium. Start with energy. Energy has the highest weight in inflation baskets in US CPI, gasoline, electricity, and natural gas together make up about 6.292%, directly impacting how consumers feel costs. Energy is a core inflation hedge whether the economy is good or bad. People need electricity and drive cars. Energy demand is inelastic, so during stagflation, energy assets can protect your returns. Then copper. Many might not notice, but copper is called the king of industrial metals, especially now. With global grid construction and renewable energy projects, copper demand will keep growing. Institutional forecasts say by 2030, copper demand growth will come from grid and power infrastructure, like ultra-high voltage energy storage stations, EV charging piles, all needing copper. Plus, copper supply is concentrated if disruptions hit, like strikes in Chilean or Peruvian mines. Copper prices will spike. Key point, gold often leads copper. Now that gold has hit new highs, copper will likely follow. That's a big signal. Then rare earths. Rare earths are the lifeline of new energy and high-tech industries. Without them, you can't make EV motors, wind turbines, or precision components for AI chips. With the global shift to renewables, rare earth demand will only grow long-term, not short-term speculation. So rare earth assets are worth long-term attention. Finally, uranium. Many overlook uranium, but it's key to energy security. In recent years, nuclear power is quietly making a comeback. France extended reactor lifespans. Japan restarted closed plants. The U.S. is pushing small modular reactors. Uranium supply is highly concentrated. Kazakhstan produces 40% of global supply. In nuclear fuel processing, Russia's Rosatom has about 44% of global enrichment capacity. Over the past 2 years, spot uranium prices rose from about $50 LB to $73 LBA, 46% gain. As global energy security concerns grow, uranium demand will increase, and supply cycles are long. New mines take 5 to 10 years or more, so short-term supply can't meet demand, meaning uranium prices have plenty of upside. The second category, real estate-related assets, especially homebuilders and REITs. Some might ask, isn't U.S. real estate crushed by high rates? 30-year mortgage rates soared past 7%, and the second-hand housing market froze. How can it be a safe haven? Fed. The key is rate cut expectations. Buffett already showed us Berkshire Hathaway opened a position in D.R. Horton, the largest U.S. homebuilder, and added to Lennar Corp. Why? Because he's not looking at current high rates, but future low rates. Once the Fed cuts, mortgage rates will drop, making homes affordable again for many young families. pent up. Demand will be unleashed. New housing starts will increase, directly benefiting home builders. More starts mean building materials, home decor, and appliances will also benefit opportunities across the real estate supply chain. Let's talk about REITs, especially data center REITs and multifamily housing REITs. Data center REITs are benefiting from the rise of AI. AI requires massive data storage and computing power, which means growing demand for data centers. Multifamily housing REITs are gaining from strong rental demand, with many young people in the US UNABLE to afford buying homes right now. They're turning to renting, keeping occupancy rates in multifamily properties high. Over the past 2 years, high interest rates have pushed REIT valuations down. But once interest rates drop, lower capital costs will boost the discounted cash flow value of REITs. That means a rebound in valuations. This is an underrated opportunity. The third category, extending the gold ETF value chain. Besides buying gold ETFs directly, take a look at companies along the gold industry chain, like gold mining and gold processing companies. When gold prices rise, profits at gold mining companies directly benefit. Take industry leaders like Newmont Mining and Barrick Gold. Their stock prices are highly correlated with gold prices, and if gold continues to climb, their earnings could surge even more than the price of gold itself. Domestic gold processors are also worth watching, companies like Lao Fengxiang and Chow Tai Fook, with growing consumer demand for gold in the market. These companies are seeing steady performance growth, and their dividend yields aren't bad either. They're a solid pick for more conservative investors. Now, some of you might be wondering, with so many assets, how should I allocate? Keep it simple. Here's a straightforward approach. Put your core allocation in gold to hedge against risks and inflation. Use satellite allocations for commodities. Think energy, copper, rare earths, uranium, maybe around 10% each to capture sector-specific opportunities. Then allocate 10% to 20% to real estate-related assets, like home builders and REITs, to position for interest rate cuts. The rest can stay in cash, ready to deploy if gold or other assets pull back. Finally, I want to keep it real with you. The market is all over the place right now. Gold is soaring. U.S. stocks are sending mixed signals, and commodities are offering niche opportunities. It's easy to feel lost or even tempted to follow the hype. But remember, investing isn't about who makes the fastest money. It's about who stays consistent and profits over time. Back during the 1970s oil crisis, some people jumped into oil speculation and got burned. During the 2008 financial crisis, some panicked and sold gold, only to miss the huge bull market that followed. The same applies today. Don't let short-term moves cloud your judgment. Understand the underlying reasons behind each asset's performance and know why you're buying and when to sell. That's how you avoid missing out or getting trapped in volatile markets. I'm Luna, your macro translator, here to help turn insights into digits in your portfolio. Now, I've got a question for you. Do you think gold can hit $5,000 per ounce? Besides the assets I mentioned, what other safe haven investments are you keeping an eye on? Drop your thoughts in the comments. I'll reply to each one. Don't forget to like and subscribe so you don't miss the next update. Catch you in the next video.